You walk into a bank. You ask for $10,000. They say yes. But here's what nobody tells you in that room. That money didn't exist 5 minutes ago. Not in a vault. Not in a drawer. Not sitting somewhere waiting for you. The bank didn't take it from another customer's account. It didn't move it from a pile of cash in the basement. It typed a number into a system. And that number became real money. Money you can spend, save, or hand to someone else, who can deposit it in their own bank, and watch the cycle start again. You just witnessed money being created. Not printed. Not mined. Created. Out of a contract and a keystroke. And almost nobody walks out of that bank knowing what just happened. This is the part of the financial system most explainer videos skip, because it sounds too strange to be true. So let's slow down and actually look at it. Right now, in the United States, total consumer and business debt sits above $17 trillion. That number keeps climbing every single year, almost without exception. Recessions barely slow it down. Wars don't stop it. It just grows. Here's the question that should bother you. If debt keeps growing year after year, where does all that money come from to cover it? The textbook answer is that banks lend out money that other people deposited. You put your paycheck in, the bank lends it to someone buying a car, everyone's happy. Tidy. Simple. Mostly wrong. That's not how modern banking actually works. When a bank approves your loan, it isn't moving existing dollars from one account to another. It's creating a brand new deposit, matched against a new liability, you, and your promise to pay it back. The loan and the deposit appear at the same moment. One does not exist without the other. In other words, the debt creates the money. Not the other way around. This isn't a conspiracy theory or some fringe idea. It's described plainly in research published by central banks themselves, including the Bank of England, which once put out a paper that quietly admitted most economics textbooks had been teaching this backwards for decades. Let that sit for a second. The institutions that regulate money were correcting the public's understanding of where money comes from. And most people never heard about it, because it didn't fit into a soundbite. So why does this matter to you, scrolling on your phone in 2026, paying off a car or a credit card or student loans? Because every dollar of debt in the system is also, somewhere, somebody's dollar of money. Your mortgage isn't just your problem. It's also liquidity in the system. Your car loan isn't just a monthly payment, it's also new spending power flowing into dealerships, paychecks, suppliers. The economy doesn't just use money. In a very real sense, the economy needs debt to keep producing money in the first place. Which means if everyone stopped borrowing tomorrow, stopped taking loans, paid off every credit card, refused every mortgage, something strange would happen. The money supply would shrink. Not slowly. Fast. This sounds backwards. Debt is supposed to be the bad guy. Paying it off is supposed to be the responsible, mature, grown-up move. And on a personal level, it absolutely is. But zoom out to the level of the entire economy, and the math gets uncomfortable. If borrowing slows down everywhere at once, banks create less new money. Existing debts still need to be paid back, with interest. But there's less new money circulating to pay it with. People who were comfortable suddenly aren't. Businesses that were stable suddenly aren't. This is, roughly, what happens during a credit crunch. It's part of what turned a housing problem in 2008 into a global financial crisis within months. The system, in other words, is quietly built to need more borrowing tomorrow than it needed today. Not because of greed. Because of arithmetic. Here's where it gets sharper. Let's say you borrow that $10,000 at 5% interest, paid back over a year. The bank created the $10,000. But it did not create the $500 of interest on top of it. That interest has to come from somewhere. And it doesn't exist yet, anywhere in the system, the moment your loan is signed. So where does it come from? It comes from someone else's loan. Someone else's new debt, somewhere in the economy, eventually generates the new money that lets your interest get paid. Multiply this across millions of loans, mortgages, credit cards, business lines of credit, and you start to see the shape of something enormous. A system where the total amount owed is mathematically larger than the total amount of money that currently exists to pay it. This isn't a flaw hiding in the basement of the economy. It's the foundation the building is standing on. Now here's the part that should make you genuinely uneasy. This structure rewards expansion and punishes standing still. If the economy isn't growing, if people and businesses aren't taking on new debt to create new money, the existing debt becomes harder to service. Interest piles up faster than income can cover it. This is part of why central banks treat a slowing economy as an emergency, even when nothing else seems visibly broken. Growth, in this system, isn't a bonus. It's the minimum requirement just to keep the math from breaking. Think about what that actually means for an individual. You are told, your entire life, to avoid debt, build savings, live within your means. Good advice, genuinely. But you are living inside a system that, at the macro level, depends on other people not following that advice. Someone, somewhere, has to keep borrowing for the system to keep producing the money that lets everyone else, including you, get paid, get raises, pay down what they owe. There's a quiet irony in that. The frugal saver and the system itself are working in opposite directions, and both are doing exactly what they're supposed to do. So who actually benefits from this? Banks earn interest on money they created with a few keystrokes, not money they had sitting around. That's not evil, it's how the license to create deposits has worked for over a century, but it is wildly different from the mental image most people carry of a bank as a vault holding other people's savings. Governments benefit too, in their own way. When a government runs a deficit, it borrows. That borrowing also injects new money into the economy, just at a much larger scale, and through a different mechanism involving central banks and bond markets. The same basic principle applies. The debt isn't just a liability sitting on a page somewhere. It's also fuel. This is why national debt clocks make for great dramatic footage but terrible standalone analysis. A number with 12 zeros on a screen looks like impending doom. It might be. But it's also, mechanically, tied to how money got into your hands in the first place. None of this means debt is harmless. None of this is an argument to go borrow more. If anything, understanding the mechanism makes the personal stakes clearer, not smaller. Your individual debt still has to be paid back, with real money, earned through real work, on a real deadline. The system needing expansion doesn't soften that for you. If anything, it explains why the pressure to keep up, keep earning, keep borrowing just to stay even, never seems to let up. You're not imagining that pressure. It's structural. Which brings us to the uncomfortable zoom out. A system that requires perpetual growth, fueled by perpetual borrowing, to avoid breaking down, is a system that has no natural stopping point. It doesn't pause when people are tired. It doesn't pause when wages stop keeping up with prices. It just keeps requiring more, because the alternative is contraction, and contraction is when cracks start to show, the way they did in 2008, the way they have at smaller scales many times since. So here's the question worth sitting with, long after this video ends. If the money in your account, the money you're paid with, the money the entire economy runs on, only exists because someone, somewhere, agreed to owe more than they have, what exactly are we all building toward? And what happens the day enough people stop agreeing to play their part in it?